Hello, students at home. Welcome to online teaching of St. Charles College, Onitsha. I'm Mrs. Obi Kate from Economics Department. The topic for the lesson today is types of financial institutions. Before we go into the lesson, I would like you to take note of the following specific objectives, which you ought to know by the end of the lesson. The first one is define money market. You should be able to also mention two instruments used in the money market. Again, explain one of the instruments used in the money market. Also, enumerate 4 institutions that fall under money market. And finally, mention 2 instruments used in the capital market. Now, we are going into the lesson. We are starting with meaning of money market. Now, let me tell you, it doesn't imply, because here in our lesson, we are going to discuss 2 types of financial institutions, which are money market and the capital market. But it does not mean that we only have these 2 as the types or as the only types of financial institutions. No. Remember that previously we have discussed other types of financial institutions. So we are now left with capital markets and the money market. So what is the meaning of money market? Money market may be defined as a financial market for the lending and borrowing of short-term loans. This type of market is all forms of business transactions. A lot of financial institutions involved in this type of market purchase and sell funds on short-term basis. Then, instruments used in the money market. When we are talking about instruments, we do not mean shovels, machetes. No. These are what are being used by investors and the owners of money market to transact business. And what are these instruments? One, we have treasury bills. Treasury bills, they are first-class securities issued by the government as a means of borrowing from the public. They have fixed duration of time and specific interest rate. They are discountable. When we say they are discountable, it implies that if you want to present your treasury bill before the due date, then some amount of money or some percentages will be deducted before you are being given your balance. Then we have bills of exchange. Bills of exchange is defined as a written order from one person to another. From that one person is the payer or the creditor. Remember that the creditor is a person to whom something is owing. To another, signed by the creditor giving it, requiring the person to whom it is being addressed to pay on demand or at some fixed future date a certain sum of money, either to the person identified as a payee or to only person presenting the bill of exchange. So, bill of exchange, the person that writes it is the creditor and not the debtor. Like in case of check, you know that the person who writes the check is the debtor. But in this very case, it is the creditor. Then we have trade bills. Now, trade bill is defined as a bill of exchange issued and or endorsed and being accepted by a non-bank entities at rates higher than the rate for the bank bills. What this implies is that trade bills are being honored by those institutions that are not banking institutions. Now, there are institutions that fall under money market. These institutions are commercial banks, central banks, merchant banks, finance companies, discount houses, and hire purchase companies. Now, what are the functions of money market? The functions of money market are provision of avenue for implementing government policy. By how? It implies that the market is used for short-term securities of central banks through which they buy and sell something like treasury bills. Then, sources of short-term borrowing, avenue for fund mobilization and utilization. It helps commercial banks to hold cash reserves. It also promotes liquidity and the safety of financial assets. We are now going over to capital market. Capital market may be defined as a market for lending and borrowing of long-term loans. The money lent and borrowed in this type of market is used to finance capital projects. It is put forward that industry and commerce use the capital provided in the capital market to establish new business, to enhance the existing businesses, and to finance expansion of businesses. So, the difference between capital market and the money market is that money market is for short-term borrowing, implying a period of few months or a year. But capital market takes longer periods, maybe 2 years, 3 years, 5 years, or as the case may be. So when you want to go into a capital market, into a capital project, and you need loan, then you go for capital market. That's where you secure your loan. Then, what are the instruments that are used in the capital market? 1, shares. What do we mean by shares? I know some of you sometimes, you might have heard your parents saying, I have shares in this company, I have shares in that company. What actually do we mean by shares? These are financial instruments utilized in the capital market for long-term investments. A share is a portion of capital of limited liability companies. For instance, if you want to buy a share of a company, what it implies is that you are investing your money in that company. If a company is selling shares and you want to partake and be one of the owners, because the shareholders are owners of a company, then you contribute towards the capital of that company by buying shares. By buying that shares, you become one of the owners and you are being called a shareholder. And shareholders are entitled to what is called share of the profit, known as dividend. Then we have bond. Bond is a long-term financial security used to source for funds. Bonds may be issued by firms, financial institutions, or governments. Bonds issued by government are generally regarded as safe. So sometimes when government need to borrow money from members of public, what they usually do is they sell bond to the members of the public through central bank via commercial banks. And when they sell that to you, you give money to them, then they pay you interest. Then we have treasury certificates. They are government financial securities which mature after a year. They are issued by government through central bank to either borrow or lend money in the capital market. Then we have debentures. These are secured loans raised by a company, usually with fixed interest for some fixed redemption rates. So debentures are used by companies to borrow money from members of the public. People that lend money to companies through debentures, they are called debenture holders. Debenture holders are not owners of the company. Rather, they are creditors to a company who are entitled to receive interest. And they are being paid interest before sharing of profit to shareholders. Then we have institutions that fall under capital market. These institutions are 1. Issuing houses, 2. Development banks, 3. Investment banks, 4. Mortgage banks, 5. Insurance companies, 6. Investment funds, 7. Savings banks, and 8. Stock exchange. Then what are the importance or functions or advantages of a capital market? 1. Savings mobilization. Through the activities of operations in the capital market, savings are mobilized in the economy. 2. Encourages the growth of merchant banks. The capital market makes it possible for merchant banks to grow, which specializes in banking and the corporate financial services. 3. General public participation in economic activities. It provides opportunities to the general public to participate in the running of the economy. Provision of long-term loans or capital. It is a machinery for mobilization long-term financial resources for individual development. And finally, employment opportunities. The capital market provides employment opportunity for many people in the economy and also enhance the general standard of people. Then, we have a stock exchange market. This stock exchange market is one of the institutions that fall under capital market. We are going to discuss it because we have discussed others previously. So, what do we mean by stock exchange market? Stock exchange market is an organized market for exchanging securities. When we mention security, we don't mean the security men. But securities, they are what are being used to transact business in the capital and the money market, like shares, bonds, treasury bills. These are referred to securities. So don't take it to be those security men at the gate now. So the securities, it is a branch of capital market. Stock exchange is a branch of capital market where existing stocks, shares, and the other kinds of securities are bought and sold. It is simply a highly organized market for the purchase and sale of second-hand securities. For this reason, it is also known as a secondary market. Now, let me explain second-hand securities. Second-hand securities do not imply something like okreka. No. But second-hand securities, they are shares which have been bought by a shareholder for some years. Then that shareholder now want to resell the shares. The only place where such resale of shares will take place is in the stock exchange market. Stock exchange market does not sell first published shares or newly published shares. What you buy from the stock exchange market are already existing shares. So those already existing shares are referred to as second-hand securities. The history of stock exchange started in Nigeria with the Lagos Stock Exchange, which was granted certificate of registration of business name in March 1st, 1959. It was incorporated on September 15th, 1960, and commenced business on June 5th, 1961. Later, it was transformed by the federal government of Nigeria as Nigerian Stock Exchange, with additional branches in Kaduna and Port Harcourt. Today, the branches are in all states of federation, including Onitsha. Organizational setup. The management board was elected at the annual general meeting. The board of council was headed by president, while a director or general manager heads its administration. The council made policies that guide the operation of stock exchange. It draws the rules and regulations for the stock and grant quotations to companies in using of securities. The owners or shareholders of Nigerian Stock Exchange are financial firms and institutions. The principal agents of Nigerian Stock Exchange are stockbrokers, jobbers, issuing houses, and others. Dealers in the stock exchange market. Who are the dealers? The dealers are divided into two. The main principal dealers, which are made up of brokers, jobbers, and issuing houses. Other dealers are called speculators, and they are bulls, starts, and bears. Then who are the brokers? The brokers are agents, either a firm or group of persons that can buy and sell securities on behalf of investors, either individual or firms. They can also act as underwriters. That is, they can take up any shares. Not brokers act as agents of individuals or firms who wish to sell or buy securities. The individual or public do not operate directly with stock exchange, but with their brokers. The commission of a broker is called brokerage. Then we have jobbers. The jobbers are main dealers in the stock exchange, and shares and the other forms of securities. The jobbers deal directly with the broker and has nothing to do with the public. The jobbers has two prices: lower price for buying, higher price for selling, which implies that the jobber buys shares at a very low price and sell at a high price in order to make profit. The difference between the prices, that the high price and the low price, is called his profit, and that profit is called margin or jobber's turn. Issuing houses. It is a financial institution which makes issue of shares on behalf of public companies or governments. It gives advice on the type of security to be offered, the method and the time of issue, and the terms of the offer. It also negotiates with the Council of the Stock Exchange for a quotation and assists in preparation of prospectus. Then, others, other dealers in the stock exchange are called speculators, and they are: 1, bulls. The bulls here, we don't mean the animal, but these are speculators who buy shares, hoping that the price will rise so that they can sell at a higher price and make profit. So what it means is that the bulls, they buy stock or shares when the prices are very cheap, with hope to sell when the price of the shares increases. Then bears, these are also speculators who sell shares, hoping that their prices will fall so that they can buy them back. What implies is that the bears already they have the shares, but they have what is called fear of future fall in price. Fear of future fall in price of shares. So at that moment, when they feel that the price of the shares has increased, they will just sell, hoping that the price of these shares will fall in future. So when they fall in future, they will then buy them back and keep, hoping to sell again when they increase. Then we have the stocks. Who are the stocks? The stocks are speculators that buy new shares. You know that normally when new shares are being on sale, the prices of these new shares are usually very low. So the stocks, they buy new shares with the hope of making profit, because they believe that price is fixed by issuing authorities is very low, that the price will be high when the shares surface at the stock exchange. Now, what are the functions of stock exchange? 1, buying and selling of old securities. They buy and sell old securities. Then, stock exchange raises capital for development. They do this by providing long-term loans to investors. Again, it provides employment opportunities. Most people earn their living through stock exchange, especially the dealers. Then it raises administrative efficiency of the companies. This they do by allowing shares of reputable companies only to be quoted. attracting foreign investment. Through the stock exchange, foreigners who wish to invest in the country are made aware or exposed to the opportunity. Help government to raise capital. And finally, they draw up rules and regulations. Then we have what is called secondary market. What do we mean by secondary market? The market for resale of shares. This is distinct from the market for new shares. The vast majority of dealings in the shares is in the secondary market. The existence of a liquid secondary market for shares is an opportunity, is an important factor in making them sellable as new shares. If people who are intending to buy newly issued shares, knew they could not sell them readily, but had to return them permanently, they would be much more reluctant to risk buying them in the first place. So, secondary market is hope for those that want to resell their shares in future. Then, primary market refers to market that sells shares for the first time. This market for the sale of shares that is being quoted for the first time, that is coming out for the first time. So, having listened to the lesson from the beginning, we started with the meaning of a money market, institutions that fall under money market, the functions of money market, the capital market, meaning of capital market, functions, and the institutions and the instruments that are being used in the money market. Then also, we discussed stock exchange. So, we are now going to do our evaluation. 1. Define money market. 2. Mention and explain instruments used in the money market. 3. Define capital market. 4. Mention and explain instruments used in the capital market. 5. Explain stock exchange. Then 6. Who are the principal dealers at the stock exchange market? Explain them. My dear students at home, try to do your assignment and submit to this number on the screen. Thank you very much.